Welcome to the ALX Show, your premier source for DFW real estate data and insights. Let's get to it. Hello, and welcome back to the ALX Show. Today, I am delighted to say we have the whole team gathered today to talk on today's show. It is one day after Labor Day. So, gentlemen, Josh, Patrick, how was your Labor Day? Did you have a good weekend?
I did, yeah. It was all good over here. Really just hung out with the family. We're about to take a trip this week. Patrick's going out of town too. So we just kind of stayed around the house, hung out with friends, watched football. It's so great to have football back on.
Mm-hmm.
Got some good games. OU won. Patrick, I'm sure would like to talk about the A&M game a little bit.
Yeah. Well, I mean, that's just about life as an A&M fan, typical as it can get. So,
Oh, man.
so yeah.
At least it was a good game. This came down to the
Yeah,
end.
it was a good game. It was fun. It's fun that college football's
That's all that
back.
matters. Amen. Amen. Well, markets were open today on less happy news. Stocks are down quite a bit, led by tech mostly. Josh, Patrick, give us a little rundown. What happened today? Why are we down 2% on that? What is it? 3% on the NASDAQ, 2% on S&P. What's going on?
Yeah, I mean, as best we can tell, it's all a result of some weak manufacturing data that came out this morning, both here and out of China. So we're just seeing, people are projecting a lot less economic activity moving forward, and just slower growth overall. So we're seeing, the markets react to that. We're seeing oil react to that. And I think there's this fear that we could be in or coming into a recession, on the heels of the labor report that came out last month. People are just, the markets, everyone's just kind of on edge. It seems like anytime there's, any type of data that's, one-sided or potentially scary, there's a big move. And it's just because we've been in an unstable environment for so long. So we feel the same way, everyone's just so reactive to any piece of data. Now the bad manufacturing data, that's a big one. That's 10% of our economy. So if that starts to go down, it also represents 10% of the employment in our country. So if we start to see massive layoffs in the manufacturing industry, then, that has a lot of effects, significant effects throughout the rest of the economy as well. So, I mean, there's reason to be concerned, and we'll see how the Fed addresses it here in a couple of weeks.
Well, I also know you guys are tracking some real estate data within DFW, and I know we've got labor data coming on Friday, and everybody's anticipating a Fed reaction, but even still, there's some activity going on in DFW real estate. So tell us a little bit about what you guys are tracking and what that looks like right now.
Yeah, it's a weird residential market. I mean, anybody that owns a home or keeps up with the market knows that, and it's been that way for a long time. You've had the interest rates that have shot up, the mortgage rates that have shot up after being low for a few years there, and it's just really caused a lot of, like we talked about, for instability, volatility, and people are kind of waiting and seeing. I mean, everyone's hoping that interest rates go back down at least a little bit, and they're starting to. Like we're below 6.5 now. Which were up to 8, not that long ago. So, I mean, we are seeing some positive moves, as far as just interest rates and affordability. Now on the home value side, we're still seeing a very gradual increase in the average home values. We're at all-time highs as far as what, average or median home costs in this country. And, certainly here in DFW, it's the same. So, we've got very expensive homes. We've still got high interest rates, and we also have all this uncertainty. Where are rates going to go? We've got the presidential election up here in a couple months. So it's just we're seeing, what the rest of the country is seeing. It's just kind of a wait and see approach. Everyone's hoping that we got the good readings on inflation last month, CPI and PCE. So there's reason to be optimistic with what the Fed's going to do, and that them feeling confident that, okay, it is time to start cutting rates. And now, all attention is going towards the labor report that comes out on Friday. So I think we're just seeing it's homes are still moving, and homes, life circumstances will always, there's always life circumstances that will cause people to move. So homes are still selling. But we are seeing the days on market tick up, and we are seeing months of inventory go up. Patrick and I were looking at this earlier. In January, months inventory was 3.2 months. In August, it was 4.7. So pretty significant jump in a matter of 8 months. Just starting to show the trends, and it's been moving up consistently since the beginning of the year. So just showing that trend of more inventory taking longer to sell, which should eventually, with that in combination with higher interest rates, higher mortgage rates, have put deflationary pressure on prices. So, and that'll, as soon as people feel comfortable with, get some stability back in, and people feel comfortable with rates and prices, I think the market will start to open up.
If that inventory number, which in commercial world we'd call supply, if that is going to continue to tick up, then demand is strong and stable. But the only thing that can do is help affordability, unless there's a wild spike in demand that you really can't foresee coming in any way. So that'll help affordability. And then the big question is, what's going to happen to the long end of the curve when the Fed starts to cut rates? So we know we're going to get short-term rate relief. That doesn't necessarily help mortgage rates. You can make an argument either way. Longer dated, like 10-year treasury notes are going to either, they might fall a little bit as we start to cut, but you could make an argument just as well that they're going to maybe tick back up a little bit. And we could be in a period where, a mortgage rate in the 6% is kind of normal for the next, however long. So that's the other big question, I think, in the residential world right now.
Okay. Yeah. So if the employment, depending on the employment data that comes out on Friday, do you see any kind of effect that might have on housing as you're seeing it right now? Like, is that, like, I think you made a comment earlier, like people are waiting to buy homes until they feel a lot more stable. Like, what is the expectation on Friday, and how do you see that kind of playing out in the near term, maybe?
I don't, a low number could mean the Fed's going to do a 50 basis point cut, and that will have an effect on treasuries. But we also need to remember that mortgages, the prices are set based on the secondary market where mortgage-backed securities are sold. So if you have a labor market that's deteriorating, then does that mean you need higher risk premium on the mortgage-backed securities? So it's just, so, and if that's the case, then mortgage rates, like Patrick was saying, aren't going to come down as much as people might like. So we just have to wait and see. It's all about the confidence of the investor and the risk premium on those mortgage-backed securities based on how they feel about the economy and the strength of those homeowners who are ultimately paying on those loans and providing yield on those investments. So there's a lot to it, and it's a big, complicated system. We're not, we don't want to pretend like we know it all, but or even close. But we do know that the mortgage rates are going to be determined by investors who eventually buy these mortgage-backed securities and how they feel about the risk involved in purchasing those, and what kind of risk premium they're going to need. To buy a lot of them, you need volume, right? You need a lot of volume to push those to push those rates down. So we'll see.
Have you heard anything on the streets about how investors might be feeling, that coming into this fall, like just any kind of like anecdotes that you might have? I'm always curious, like you guys are talking to, banks and lenders and investors and, developers all the time. And I'm just curious, any kind of like word on the street that might be a little bit harder to find, on the newspaper, but anything that's interesting that's come up lately?
Well, I think that in the lending world, everything is still really tight. There's not a ton of activity. I don't know. It's almost like every forecast that comes out. If you read any lender survey or talk to anyone, it's always like, well, over the near term, we think things are gonna be really slow, but we expect in the next, half of the next year that everything's going to pick up. And we've been hearing that story for like 3 years now. So, I mean, who knows when activity will pick up? The fear, like, and just what Josh is saying, to bring it back to beginning of this with talking about what the markets did today, that's all the same fear. The fear is and it started with the last jobs report a month ago, is that when the Fed tightens, you have such a lagging effect that you don't know how tight you're tightening. And it's really, really hard to unscrew those screws once you've tightened them in. And so the fear that everyone has is went from, man, we have to kill inflation, but we can have a soft landing and, operate business as usual. Activity will pick up again just fine, to, oh man, we might have, slayed this inflation question, but now in doing so, we tightened so much that now we're trying to panic and unwind this. And that's going to take a really long time. And are we going to kill activity and productivity in the meantime while we're trying to work through it? And I think that's everyone's fear.
Like we talked about, there's two mandates for the Fed, right? Price stability and full employment. So now they, like Patrick's saying, they've shifted. They feel pretty good about where inflation is, especially from where it was. And now the second part of their mandate is full employment. And now we're looking at a trend line of unemployment rate, which is ticking up. Now, economists think that this week it may come down to 4.2. It was at 4.3 last month. So they may think, it could have improved a little bit. But as we're seeing over the last several months, it is going up. So they're going to want to do something about that.
Yeah. Especially with an election season. I know, Fed's independent and all that kind of stuff, but it's definitely a sticking point. But to your point, I mean, it takes a while for all that to unwind through the system. So even if the Fed makes some decisions at 50 basis points, mid-September, it's still going to be, a year maybe until we see that filter through the system? I mean how do you guys think about that?
12, 18 months for you to start to feel the effect of a rate increase or decrease. So does 25 basis points do much of anything except for just sentiment? Like it makes people feel better. Now that is important.
Which is powerful. I was about to say. Yeah.
Human emotion is very powerful. Leads behavior, which, can make a huge difference. But statistically, really in the numbers, does it move things that much? Does it 25 basis points really make lending that much more affordable? They said no, it doesn't. It doesn't move things that much. But the important thing is where they're going. So they're like, the projection is 100 basis points by the end of the year. Now we're starting to have some serious movement that can really change things. But again, like to Patrick's point, well, how long though? Because they don't meet, on a consistent basis at the same time every month. They somewhat consistent, but it's towards the latter parts of the month. So how long is it going to take until we really start to see the effects of the cutting cycle? And we just don't know. I don't think anyone really knows. It's impossible to tell for sure, but everyone does know it takes time.
Yeah, for sure. Well, as part of that, but switching topics a little bit, there was an article that came out in the Wall Street Journal yesterday that apartment construction is slowing and investors are betting on higher rents. And so the summary is the rise in interest rates push construction loan costs up and property values down. But now, big investors, this is a line from the article, big investors are betting that downward pressure on rents from new supply is coming to an end and the market is shifting back in landlords' favor. At the heart of their reason is the critical metric of new construction starts, which began slowing last year and now are falling even further. And so they show this chart of apartment units started quarterly. And from 2015 to 2022, you see kind of flat around 100,000 units, a little bit more. And then it jumps in early 22 up to 200,000 units. And now it's fallen sharply to the last reading that they have here from CoStar data. That's about 50 to 75,000 starts. So I'm curious from y'all, what's your take on that? But also, are you seeing that kind of effect, especially in DFW? I mean, I know that's, Wall Street Journal covers national data, but what you guys might be seeing here on the multifamily side?
Let's start by, I want Patrick to jump in here because he's really been studying this, but start about why the boom. Why did the starts jump so drastically? Patrick, you going to speak to that a little bit?
Well, yeah, I mean, it was a collision course of, pent up inactivity happening after 2020, super cheap debt, making projects look really viable and strong, continued strong demand metrics, making their look rightfully like a big need, and chronic undersupply that we've been in nationwide, housing wise for forever, really. So all that, took off in 2022, and all that really began, and we knew that wave was coming, and rent growth kind of took off at the same time too. So back then everything was undersupplied, and that's when rents flew up, and for some reason are still affecting the inflation measurements of rent.
Stimulus too, right?
Yeah.
Affected rents.
Oh yeah.
All the government stimulus.
Mm-hmm.
People had more money to spend on rents. And it took a while for all this new supply to hit market. Like Patrick said, we're undersupplied. So we had a lot more money chasing after fewer units at the time. That's not the
So
case.
rents went up, which drove, the profit making abilities of developers and investors and all that go into the market.
Everybody forecast that,
Yeah.
right? And it was significant. We were seeing 20% growth year over year, 22 to 23. I mean, so it was significant. So when you're putting your pro forma together about, hey, I can go develop this project, I've got super cheap debt to go get it done, and I've got these great forecasts on rent growth over the next several years. So if I can get in and efficiently build this apartment complex, get it leased up and sell it within the next 3 years, then, I stand to make a lot of money. So it makes a lot of sense. Not to mention population was growing. Business has always done really well here in DFW. It will continue to do so. So it's a great market to invest in just generally, but then to also see, well, it needs more housing units. So all these developers we're looking at all these things and looking at these performers, looking at the projections and thinking, this is a great opportunity, and rightfully so.
Yeah. So all this began in 2022, like you said, and we knew that the bulk of that was going to start to be delivered this year in 2024. And in that Wall Street article, it talks about it being a nationwide problem. DFW, raw numbers wise, is the epicenter of all of it. Percentage wise, we're so large that, it might not be as effective as, some smaller markets, but raw number construction starts and deliveries, we're kind of running it right now, for better or for worse. And so, what that did when all that came online, obviously a huge increase in supply. It's tough to have, spikes in demand. Demand's normally kind of a stable thing to forecast. That, really made rent growth turn negative for the first time in a really long time. And so, that was kind of the situation that froze the market, essentially. Buyers don't want to buy something where a year or two down the line, your revenue is going to be the same. Your expenses are going to be higher. So that froze them out. People who already own don't want to sell because of the situation we just talked about with, purchasing property with cheap debt and lofty expectations for revenue growth. Circumstances change and now you're just holding on. Don't want to get out at a loss. You want to ride the wave through it. So froze everything. But now we're coming through the crest of that wave, and the expectation is, broadly, it doesn't take a genius to figure this part out, but that as we start to absorb all that new supply, then rent growth is going to come back. So people would tell you that, over a 5 or 10 year horizon, now's a great time to buy if you believe this story, that rent growth is going to come back, and you can get in at a time where you don't have to forecast a ton of rent growth to be competitive with what you're offering on a property. So that's a compelling story. What I think is even more interesting, though, than the supply side of it is what's happening on the demand side, and because it's happening here in DFW too. And this was something that, that whole thesis kind of developed without this being a part of it. But I think this is like an added benefit to it. But in DFW, we signed a record amount of multifamily leases in the second quarter. Can't remember the exact numbers, around 100,000. But we signed a huge number in the first quarter, slower leasing season. Second quarter, blowout number. And it was kind of puzzling because we're delivering all this supply that's supposed to be like way excess of demand, yet we're still absorbing a lot more than we thought. And the folks who have studied this have found that there's an increase in household formation. So what used to be roommates coupling together and leasing a unit together are starting to decouple.
Hmm.
And, a lot of that coupling, I think demographers would tell you happened in 2020 when things were uncertain. That tends to happen, uncertain, kind of huddle up and, don't take any gambles or any risks, and that we're kind of moving through that now. And so there's this big decoupling happening where a 3-bedroom apartment's now 3 1-bedroom apartments. And so the demand is a lot stronger than anyone really thought it was going to be. So that is making rent growth rebound right now, even as all this new supply is being delivered. So, the year-over-year numbers would tell you that DFW rent growth is still negative. But if you look at the month-by-month numbers, I think the ALN data for month over month I think it's just got the annual, but I think the month over month is like a 0.2 or 0.3% increase from July to August. So rents are on the upswing again. They're not past where the year over year makes them positive, but it is growing again, even with all this supply, and is a real kind of testament to the level of demand that we have here.
Wow. That is all very fascinating. Josh and I have been talking a lot about how DFW seems to be just exploding, which is great, for a number of different reasons. But you're saying there's also maybe how social isolation is affecting rent growth as well, because of that decoupling. That's a fascinating little.
Yeah. Well, and what you would hear is and a common explanation would be that demand is stronger because renters can't afford to buy. And there probably is some truth to that, but I think this explanation is a lot more compelling.
Interesting. Okay. So not only is it what you would typically see in economic indicators like, business growth or business freedom, the land values, things like that, but also just like some social elements too, like from COVID, now people are wanting to, just have their own place maybe. Or maybe it's as people are getting older, they're wanting to separate from more traditional roommate situations, which is kind of interesting.
Yeah.
Fascinating. Okay. Good to know. Any closing thoughts today on what's going on this week in markets and just any kind of data you guys are tracking? But what you said is really interesting. I haven't thought about that at all.
No, I think we just, we've got a big week. Friday's numbers will obviously be very meaningful for the Fed's path forward. And, there's a lot, it's just one piece of data, but it'll certainly be very meaningful for helping them make their decision here in a couple of weeks, as far as do we cut by 25 basis points or by 50.
Yeah.
So we'll be looking for that. Otherwise, we're DFW investors, real estate investors, as we talk about all the time. So we're very optimistic. We think that, like we're talking about the supply, the multifamily supply and all that's come online. And Patrick mentioned this, that if you've got a 5 to 10 year horizon, then there could be a big payoff, because as this supply starts to as the starts start to taper off, population's not going to stop increasing. Companies are not going to quit moving here. More and more jobs are going to continue to be created. So there's going to be a very healthy demand for housing units. So as a new product or the new supply starts to become less and less, just as people, you got to remember too, how long it takes to plan and develop and build one of these big apartment complexes. It takes years. So there's going to be a window where we're going to be undersupplied again, if not for an extended, period of time. During that time, we think it's going to be a great opportunity for multifamily owners to make some good returns, both through cash flows on rent, but then also to sell. We've been in this period for a while where cap rates have pushed up because interest rates have. But as interest rates start to come down, as supply starts to come down, demand stays steady, even here where we are grows, then we're going to be in a really good situation. So we're excited about 2025, 2026, and beyond. And we think there's going to be a really nice window there to to see some good things happen.
Cool. We've been talking for weeks, months on this podcast that we're super bullish on DFW. So I love seeing how the data may play out in that way. So I guess we'll see. But thankful for both of you for your insights as always. And I'm excited for next week. We'll see what the data comes out on Friday and how that impacts markets Monday, Tuesday. And we'll get back to you on the insights from then on the show next week. So we'll see you
Sounds
then.
good. Thanks,
Great.
Brandon.
Bye.